Real estate has created more millionaires than almost any other investment. But today there's a big question that many investors are asking. Do you actually need to buy a rental property to build wealth? Or can you achieve the same results by investing in real estate ETFs from your phone? Imagine two people starting their real estate journey today. The first person saves 4 years, puts tens of thousands of dollars into a down payment, deals with banks, paperwork, repairs, and tenants, hoping that one day the property will pay off and create long-term wealth. The second person opens a brokerage account, invests a few $100s into a real estate ETF, and starts earning passive income without ever fixing a broken sink or answering a tenant's late-night phone call. Both are investing in real estate. Both are trying to build passive income, but their journeys look completely different. So which strategy actually works better in 2026? Is owning a rental property still the best path to financial freedom? Or are REIT ETFs becoming the smarter and easier choice for modern investors? In this video, we are going to break down the real differences between rental properties and REIT ETFs in the simplest way possible so that even beginners can understand. We'll compare startup costs, passive income potential, risks, time commitment, and long-term returns so you can clearly see which option fits your situation. By the end of this video, you will know whether rental properties or REIT ETFs are better for beginners, which one requires less money to start, which one generates more passive income, and which strategy has the potential to build serious long-term wealth. We will also talk about real examples of REIT investments like the Vanguard Real Estate ETF and dividend-paying real estate companies such as Realty Income Corporation so you can understand how investors are making money without owning physical property. If you've ever wondered whether you should buy a rental property or invest in real estate the simple way, then this video might save you years of costly mistakes and help you choose the strategy that actually matches your budget, your time, and your financial goals. Rental property basics. A rental property is one of the most traditional ways to invest in real estate and build long-term wealth. This strategy involves buying a physical property such as a house, apartment, or small building and renting it out to tenants in exchange for monthly income. Many investors choose rental properties because they provide two major benefits: regular cash flow and long-term appreciation. Every month, tenants pay rent, and part of that rent can cover your mortgage, taxes, and maintenance costs. Over time, as the loan gets paid down and property values increase, your net worth can grow significantly. One of the biggest advantages of rental properties is control. You decide how to manage the property, how much rent to charge, and when to sell. Unlike stocks or funds, you have direct ownership of a real asset. Another major advantage is leverage. With real estate, you can control a large asset using a relatively small down payment. For example, a $40,000 down payment might allow you to buy a $200,000 property, meaning you benefit from appreciation on the full property value. However, rental properties also come with responsibilities. Property owners must deal with repairs, maintenance, and tenant management. Sometimes tenants move out and the property sits vacant, which means no rental income. Unexpected expenses like roof repairs or plumbing problems can reduce profits. Rental properties require significant upfront capital. Down payments, closing costs, and renovation expenses can easily reach tens of thousands of dollars. Because of this, rental property investing is usually better suited for people with stable income and savings. Despite these challenges, rental properties remain one of the most powerful long-term wealth-building strategies for investors who are willing to put in the time and effort. REIT ETF basics. REIT ETFs offer a completely different way to invest in real estate without owning physical property. A real estate investment trust (ETF) is a fund that holds shares of multiple real estate companies, allowing investors to own a diversified portfolio of properties through a single investment. Instead of buying a house or apartment, investors simply purchase shares in a fund that owns shopping centers, apartments, office buildings, warehouses, and other real estate assets. One popular example is the Vanguard Real Estate ETF, which holds dozens of real estate companies across different sectors. By investing in a REIT ETF, you gain exposure to many properties instead of relying on the success of just one building. This diversification helps reduce risk and makes the investment more stable over time. REIT ETFs are traded on the stock market, which means they can be bought and sold, just like regular stocks. This makes them extremely convenient and accessible. Investors can start with a small amount of money, sometimes even less than $100, making REIT ETFs ideal for beginners. Another key feature of REIT ETFs is dividend income. Real estate investment trusts are required to distribute a large portion of their profits to shareholders. This means investors receive regular payments without managing tenants or maintaining properties. However, REIT ETFs also have limitations. Investors have no control over individual properties or management decisions. The value of REIT ETFs can also fluctuate with the stock market, which means prices may go up and down in the short term. Despite these drawbacks, REIT ETFs provide a simple and low-cost way to invest in real estate with minimal effort. Startup cost comparison. One of the biggest differences between REIT ETFs and rental properties is the amount of money required to get started. Startup costs often determine which investment option is realistic for beginners. Rental properties require a significant amount of capital before you can even begin earning income. Most lenders require a down payment of at least 20% for investment properties. On a $250,000 home, that means a down payment of $50,000. In addition to the down payment, investors must pay closing costs, inspections, legal fees, and sometimes renovation expenses. Unexpected costs are common when buying property. Many homes need repairs before they can be rented out. New flooring, painting, or appliance replacements can add thousands of dollars to the initial investment. Because of these costs, rental property investing is often difficult for people with limited savings. In contrast, REIT ETFs have almost no barriers to entry. Investors can start with very small amounts of money and build their portfolio gradually over time. A single share of a REIT ETF can provide exposure to dozens or even hundreds of properties. For example, investors can buy shares of the Schwab US REIT ETF with a small initial investment. This allows beginners to enter the real estate market without taking on large financial risks. Lower startup costs also reduce pressure on investors. With rental properties, a large amount of money is tied up in one asset. With REIT ETFs, investors can start small and increase their investments over time. For beginners or investors with limited capital, REIT ETFs are usually the easier and safer option to start building real estate wealth. Passive income comparison. Passive income is one of the main reasons people invest in real estate. Both rental properties and REIT ETFs can generate income, but the way they produce that income is very different. Rental properties generate income through monthly rent payments from tenants. Ideally, the rent collected should cover mortgage payments, property taxes, insurance, and maintenance costs, while leaving extra profit for the owner. This remaining profit is known as cash flow. Strong rental markets can produce steady monthly income, and rents often increase over time. This can help investors keep up with inflation and increase profits in the long term. However, rental income is not always consistent. Vacancies, repairs, and late payments can reduce income. REIT ETFs generate income through dividends. Real estate companies distribute profits to shareholders, and investors receive payments regularly. These dividend payments are usually predictable and require no effort from the investor. Some well-known real estate companies such as Realty Income Corporation are famous for paying consistent dividends to investors. The main advantage of REIT ETF income is simplicity. Investors receive payments automatically without dealing with tenants or repairs. Rental properties may produce higher income in some cases, but they require more work and involve more uncertainty. For investors who want simple and reliable passive income, REIT ETFs often provide a smoother experience. Time commitment is one of the most overlooked differences between rental properties and REIT ETFs. Many new investors focus only on profits without considering how much work is required to maintain the investment. Rental properties are often described as passive income, but in reality they require active management. Property owners must find tenants, collect rent, respond to maintenance requests, and handle repairs. Even small problems like a broken heater or leaking pipe can require immediate attention. Some investors hire property managers to handle these responsibilities, but management services reduce profits. Property managers typically charge a percentage of the monthly rent, which lowers overall returns. Rental property owners also spend time reviewing applications, handling paperwork, and monitoring expenses. Managing a property can feel like running a small business. REIT ETFs, on the other hand, require almost no effort. Investors simply purchase shares and hold them over time. Professional managers handle all property operations, allowing investors to focus on other priorities. There are no tenants to manage and no repairs to arrange. Income arrives automatically through dividends, making the investment truly passive. For busy professionals or people who prefer simple investments, REIT ETFs provide a major advantage. Rental properties may offer higher returns, but they require time, effort, and responsibility. Understanding this difference is important because the best investment is not only about profit but also about lifestyle. Risk comparison. Every investment involves risk, and both rental properties and REIT ETFs have their own types of risks that investors must understand. Rental property risks are often concentrated in one location. If the neighborhood declines or property values drop, the investment can lose value. A single major repair such as a roof replacement or foundation problem can cost thousands of dollars. Tenant-related risks are also significant. Tenants may fail to pay rent or damage the property. Legal disputes and eviction processes can be expensive and time-consuming. Vacancy is another major risk. When a property sits empty, expenses continue while income stops. REIT ETFs spread risk across many properties and locations. This diversification reduces the impact of any single problem. If one building performs poorly, other properties can offset the losses. However, REIT ETFs are affected by stock market fluctuations. Prices may fall during economic downturns even if the underlying properties remain valuable. Interest rates also affect REIT performance because higher rates can reduce property values and investor demand. Both investments carry risks, but the types of risks are different. Rental properties involve operational risks, while REIT ETFs involve market risks. Investors should choose the type of risk they feel most comfortable managing. Returns are one of the most important factors when comparing REIT ETFs and rental properties. Both investments have the potential to generate strong long-term returns, but the sources of those returns are different. Rental property returns come from three main sources. The first is rental income, which provides monthly cash flow. The second is property appreciation, which increases the value of the property over time. The third is loan paydown, which increases equity as the mortgage balance decreases. Leverage is a major advantage in rental property investing. Borrowed money allows investors to control large assets and benefit from price increases on the full property value. For example, if a property increases in value by 10%, the return on the investor's down payment may be much higher. REIT ETF returns come from dividends and price growth. Investors receive regular income while the value of their shares may increase over time. Historically, real estate investments have produced competitive long-term returns compared to stocks and bonds. REIT ETFs provide steady growth without requiring active management. Rental properties may produce higher returns in some cases because of leverage and appreciation. However, higher potential returns often come with higher effort and risk. Both strategies can be effective for building wealth over long periods. Best choice for beginners. Choosing between REIT ETFs and rental properties depends on the investor's experience, budget, and goals. For beginners, REIT ETFs are usually the easier starting point. They require less money, less time, and less knowledge of real estate markets. New investors can learn how real estate works while building their portfolio gradually. REIT ETFs allow investors to diversify across many properties instead of relying on one investment. This reduces risk and provides a smoother learning experience. Rental properties may be better suited for experienced investors who understand real estate markets and have enough savings to handle unexpected expenses. Owning property requires financial stability and long-term commitment. Investors must be prepared for repairs, vacancies, and market changes. Some beginners underestimate these challenges and become overwhelmed. Starting with REIT ETFs allows investors to gain confidence before taking on larger investments. Over time, investors may transition into rental properties as their income and experience grow. The best strategy is the one that matches your current situation. There is no single answer that works for everyone. Hybrid strategy. Many successful investors choose a hybrid strategy that combines REIT ETFs and rental properties. Instead of choosing only one approach, they use both to build a balanced real estate portfolio. REIT ETFs provide diversification and passive income, while rental properties offer control and long-term appreciation. This combination allows investors to benefit from the strengths of both strategies. A common approach is to start with REIT ETFs because they require less money. Investors can build savings and gain experience while earning passive income. Later, they may use their savings to purchase rental properties. This gradual approach reduces risk and allows investors to grow steadily. REIT ETFs can also provide liquidity. Shares can be sold quickly if cash is needed for new investments. Rental properties are less liquid and may take months to sell. By holding both investments, investors maintain flexibility. Diversification across different types of real estate can improve stability. If rental income declines, REIT dividends may still provide income. If stock markets decline, rental properties may remain stable. Using both strategies can create a more resilient portfolio. The goal is not to choose one winner, but to build a system that supports long-term wealth. Smart investors focus on consistency and long-term growth, rather than trying to find a single perfect investment. As we've seen throughout this video, both rental properties and REIT ETFs can be powerful ways to build wealth through real estate. But the best choice really depends on your situation, your budget, and your lifestyle. Rental properties can offer strong long-term returns, leverage, and full control over your investment, but they also require time, effort, and a large amount of starting capital. On the other hand, REIT ETFs provide a simple and accessible way to invest in real estate with very little money and almost no effort, allowing you to earn passive income without dealing with tenants, repairs, or paperwork. Many successful investors actually use a combination of both strategies, starting small with REIT investments and eventually moving into rental properties as their income and experience grow. What matters most is not choosing the perfect strategy, but actually starting your investing journey and staying consistent over time, because real wealth is built step by step, not overnight. If you found this video helpful, let me know in the comments which strategy you prefer, REIT ETFs or rental properties. Because I read every comment, and your feedback helps shape future videos on this channel. And if you want to continue learning how to build wealth through real estate and smart investing, make sure you subscribe and turn on notifications so you don't miss what's coming next. In the next video in this series, we'll go even deeper into real estate investing and break down practical strategies that beginners can use to start building passive income as soon as possible. So make sure you watch that next video when it comes out. Remember, the best investment strategy is the one you actually start today, and your future self will thank you for taking that first step.